Welcome to Capital Link's company presentation series.
Welcome to Capital Link's company presentation webinar series. In this series, senior management of listed shipping companies provide an update on their operations, business development, strategy, and sector outlook. I'm Nicholas Bornois, president of Capital Link. Capital Link is an investor relations firm also active in event and conference organization. We work with several private and publicly listed shipping companies, including companies featured in this webinar series. As noted in our disclaimer, these presentations are purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and obviously Capital Link bears no responsibility for them. Today, we have with us Danaos Corporation. We have Mr. Evangelos, the Chief Financial Officer, and we will be soon joined by Mr. Filippos Prokopakis, the Commercial Manager. The whole session will last 45 minutes. We start with a brief slide presentation followed by a live Q&A session. Please submit your questions through the Q&A button at the bottom of your screen, and I will address them to the speakers. Alternatively, you can email your questions to webinars@capitallink.com. Thank you for being with us, and I'm turning the floor over to Mr. Chatzis, the CFO of Danaos Corporation.
Thank you, Nicholas. Good morning to you and good morning to everyone, and greetings from a white Athens. We rarely witness snow in Greece, and today it's one of those days where the whole of the city has been dressed in white. Thank you for giving me the opportunity to tell our story. Eleni, if we can move on to slide number 3 in the corporate presentation. Thank you. So this presentation is posted on our website. People can download it. We're not going to go through the presentation page by page today. I will briefly review the business and give you some information about the company, and then we will open it to Q&A, which we think is always more productive. So we are one of the largest publicly listed owners of modern container ships. We have a 40+ year history in the shipping markets, and we are one of the most efficient operators out there. We have a business model that provides strong and stable cash flow profile. Our charter backlog actually at this point is 2.8 billion. We have a few days ago announced certain transactions that increased our revenue backlog by $870 million. We have very strong contract coverage. Actually, for 2022, practically 100% of our days are contracted. And for 2023, that percentage stands close to 85%. And even if we go out to 2024, we are charter covered for 55 to 60%. So strong contract coverage that provides a very stable and visible base for earnings and cash flow. We own ships across all segments, and that's a result of our history as we have grown together with the market. We have ships ranging anywhere between 2,000 and 13,000 TEU. Danaos is a pioneer in digitization and is a champion of ESG principles. We have recently put together an award-winning Waves data analytics platform. You can find more detail in this presentation around this. We have already met the IMO 2030 carbon intensity targets 10 years ahead of requirements in 2020. And we continue to meet the target, and which is a 40% reduction. We are now at 45% lower emissions per ton miles for 2020 compared to the requirement, which is on the base year of 2008. Our capital structure is healthy and robust. We have an adjusted net debt to EBITDA ratio currently at 2.5 times at year end 2021, and it's decreasing further because our EBITDA on a contracted basis is set to be much better in 2022 versus 2021, and also because we continue to pay down debt as the quarters progress. So we're consistently reducing leverage, and as a result, we have a very strong balance sheet that gives us the ability to execute on accretive transactions out there. And actually, we have demonstrated our ability to execute and consummate accretive transactions with what we have done in the past 6 months. In the past 6 months, we have actually spent or invested rather 340 million approximately on the acquisition of 11 ships, and these investments have turned out pretty well. And obviously, all this is in the backdrop of a very strong market, which is expected to definitely continue for the next couple of years. And we expect that even if the market normalizes, because we will at some point have certain normalization in the supply chain, which currently is of course disrupted, and even if the market normalizes, we still expect to be at very healthy levels. This was my introduction, and I'd be happy to open the call to Q&A.
Evangelos, we already have a number of questions for you. The first one is, there is quite a bit of interest in your dividend distribution policy. You announced a strong dividend around a year ago, but your contracted free cash flow has materially improved since then. Is there a potential for a higher dividend payout? Any appetite for share repurchases? I mean, how do you plan to use your very robust cash flow?
Yes, thank you for your question. And starting from the last part, obviously the board is continuously evaluating capital allocation strategy, and obviously share repurchases are part of this discussion. We have in any event demonstrated that we're willing and able to use this tool, as if you recall, in late 2020 we did repurchase 4 million shares of our own stock. Now, in terms of the dividend, I do realize that certain people might advocate for a special dividend or a high payout model, but we think that that type of approach does not necessarily help or in the direction of creating value for our shareholders over the long term. We believe that the combination of a growing sustainable dividend together with share repurchases would be the preferred strategy over one-off high dividend distributions and payouts as a method of rewarding shareholders. So we have said in the past the dividend will increase pretty soon. We are already paying a $2 a share dividend on an annualized basis, and we expect that this will be increased. And as our cash position continues to improve over the next months, we will continue to fine-tune our thinking around the potential of a share buyback. And of course, we will keep the market updated on our intentions.
You know, you are in the pleasant position of having a very robust cash flow, and most of the questions that we are getting are focusing exactly on capital allocation, and so it's exactly what you mentioned. We are welcoming also Filippos Prokopakis, the commercial director.
Apologies for my late entrance. Apologies. I had some technical problems, but now they're solved. We're in the middle of a snowstorm, so I don't know if that had any effect, but sorry for that. But I'm here now.
Well, you know, snowstorms in Athens are not very common, so when they happen, then uncommon things happen. So that's expected. Going back to Evangelos for a minute, and then I will go to Filippos for the questions we got. Any particular focus on further debt repayment? That's one of the questions that we got.
Yes, look, it's all one thing, right? You cannot review one thing on a standalone basis, right? It's a matter of how do you decide to allocate capital. And of course, repaying debt is an option. Investing in growing the business is another option. And as I said, of course, dividends and repurchases are in the cards. So we have to balance it out. We already have very low leverage. We can continue to reduce it, or rather try to reduce the more expensive parts of it. But again, we will have to, at each point in time, visit these decisions with a view to the broader strategy.
So, turning now to Filippos, it is evident that the underlying container market fundamentals are very strong at this point. But some are concerned that we may see a material correction in the market sooner rather than later. What is your take on that?
Thanks for the question. I was going to address a couple of points. I don't know where you left it with Evangelos before I joined. But in any case, I believe there are two areas of concern in the container market. One is the order book, and the other one is the freight and charter rate levels going forward. And first of all, we believe that the orders, which are expected predominantly in the water only within 2024 and 2025 dates, are still manageable, since we expect demand to remain strong post-pandemic. Whilst in addition, inventories will slowly have to also be rebuilt. We have also the environmental regulation coming in 2023, and this will inevitably reduce the vessel speed, thus more ships will be needed. Therefore, we believe orders will be absorbed. And on a second point, the freight rates, and as the freight rates are concerned, first of all, liner consolidation has resulted in effective capacity management. Thus, liners have done a very good job keeping freight at sustainable and healthy levels. Also from intel we have received from our customers, we understand that shippers tend to now lock even more longer-term contracts versus the past at very healthy rates for the liners. That demonstrates also their belief for a strong spot market in the medium or short term. And lastly, in terms of the charter market, the fact that our customers are now willing to fix forward vessels, even opening mid-2023 dates at healthy rates and well above historical averages, for periods up to 5 years, is, I think, in my opinion, the main and most significant sign that the good market is here to stay for the foreseeable short to medium-term future.
Philip, it's very interesting that on one hand, as you point out, we have an order book that is growing. On the other hand, the indications right now, as you pointed out, is that you have charters who are willing today to lock in for extended periods of time. And that indicates that they also, as the end users, are expecting the tight balance between supply and demand to continue.
Yes, I mean, we have been fixing in advance as the market throughout 2022. Basically, our charter coverage for 2022 is practically 100%. assuming that some options which we expect to be declared, which were done back in the past at lower than today's rates. On the same basis, charter coverage for us for 2023 stands at about today 83%, which is already quite strong. But this is a number we expect to increase in the near time future, since interest on our 2023 openings is expected to grow as time progresses. So there's no better indicator than what we have publicly announced not so long ago, which were charter fixtures of an average of, let's say, 5 years for vessels that expired second quarter 2023. That clearly provides you an idea of how far ahead ships can be fixed accurately and ahead today.
Filippos, one of the questions we got, you already answered it, was exactly on your chartering strategy. So you gave us the fixtures for 2022, for 2023, and you mentioned the 5-year. When you fix, these are generally for how long?
As I said, I mean, it also depends on size, but if you go back to our announcement, you will see vessel sizes ranging from 2,500 TEUs up to 10,000 TEUs, and the average durations were anywhere between 3.5 to 5 years. So I don't know if that answered.
Nicholas, I mean, this is important, and as you mentioned, and Filippos also said it, it's not what we say about the market, right? When you have the big liner companies coming to you 18 months in advance of the expiry of certain charters, right? Forward fixing from middle of 2023 through 2028, this to me is a testament of and at rates which are very healthy rates, not to use any other stronger word. This shows that they have, they believe that the market will remain strong. And, the order book is currently at 23%, as it was mentioned. Environmental regulations in our view, will effectively reduce supply, because you're going to have to see slow steaming. That's the only way people at this point are going to be able to start meeting emissions requirements, and this is going to effectively reduce supply. And at the same time, demand will continue to grow. We don't expect, container trade demand to start contracting, right? So the combination of a steady demand growth, even though if it sort of normalizes a bit in the coming years, together with the expected slowdown of the fleet, means the order book can be easily absorbed. And the liners see this, because these guys want to secure the assets to run their business. So we're in it. We said early on that we're in a super cycle, and I think that continues to be the case.
One of the points that we raised, actually, we had an analyst webinar last week, and one of the points that came out from that is, I think shipping for the first time is getting to become known in terms of its significance in the global supply chain to a much broader audience. With all the supply chain challenges and with the popular motto, no shipping, no shopping, I think clearly, a much broader audience is becoming aware of the vital link of shipping in the global supply chain. Where do you see today the supply chain challenges? Are they becoming better? Port congestions and COVID-related issues?
No, they're not. At this point, we see long queues, to be able to get a berth in LA and in Asia and in other ports around the world. But, I believe that this at some point will have to normalize, right? And I cannot give you a timeline, but for the time being, it doesn't seem the case for the short term. But even if it does normalize, and that's what's important, we still expect charter rates to remain at significantly high levels. In any event, much higher than your 10 or 15-year averages. We've been through 10 years of a very, very bad market leading up to the pandemic. And I think that we sort of now are in for a good run for the coming years. Now, despite of what the market does, and that's what I want to stress again for our audience, Danaos, with the charter coverage that we have, we're pretty much insulated, right? So it's, and sorry for the power outages, but I cannot control this. So yeah, we as a company, we have a pristine balance sheet, which was done prior to the boom of the market. We had spent many hard years of trying to fix our balance sheet. It is now in pristine condition, and we are now with the good market. We are able to capitalize on it and do great things going forward. That's our story.
Evangelos, one of the questions that came in is, do you plan to continue opportunistically selling older ships given the very rich prices you can fetch right now?
We have recently agreed to sell 2 20-year-old ships. We have announced it for 130 million, so on average 65 million each. And we review each decision like that on merit. So yes, if it makes sense, we may sell again. Depends on the circumstances. At the same time, selling is one thing, but then deploying your capital accretively is another thing, and we need to find a proper balance for this.
So, if I may ask you a concluding question, why should investors consider Danaos versus one of your peers? I mean, the whole container market today is pretty much on fire. So what are the differentiating factors between you and your peers?
Well, I mean, first, and that's a fact, we are a leader in our sector, and we are uniquely positioned with one of the, if not the strongest balance sheet out there to take advantage of opportunities. Second, I would like to point our audience to the fact that to the management's track record that speaks for itself. The way we have navigated over the company over the past 10 years, where we have been, what we had to go through in a bad market and how we have come out of it, how we are now exploring and getting our hands on very successful transactions in terms of recent investments that have proven to be very good. So, we have demonstrated that we can pursue strategies that will maximize value, create sustainable value rather for our shareholders throughout the shipping cycle, and we aspire to continue doing so. Therefore, we remain committed to being, let's say, disciplined with our balance sheet and with our capital allocation, and to continue to deliver such results going forward.
Thank you. May I ask you for some concluding remarks? I mean, you summed up very nicely the investment case for Danaos. I don't know if Filippos would like to mention anything about fleet developments, the overall market, maybe technology and its impact on new ships.
As I said, I mean, the immediate effect of regulations coming in are evident. It's slower speed. That's how the existing fleet can adapt to this. That's what everything will do, and this will create need for more capacity. And I think we touched upon how this will absorb all the new building capacity coming in. I mean, in conclusion, for me, I don't know where Evangelos, what kind of points he stipulated before when I was off, but I mean, for me, in conclusion, it's our short to medium term expectations, which is 3 to 5 years, is for the market to continue performing at substantially strong levels and at well above historical averages. We've said again and again the reasoning behind this. I think that's all for me.
Well, let me thank you. It's been a very informative session, as expected. Up, we have one more question that just came in. Let me see what it is. Well, the question is that containership rates seem to be turning up earlier than their usual seasonal expectations. Do you see that as correct and continuing? I think you answered that, Filippos, but take another stab at it.
Yes, I mean, I understand the nature of the question. I mean, yes, we are outside the normalized seasonal cyclicality with peaks and declines depending on the season, pro-Christmas or Chinese New Year and all these factors coming in. I think we are experiencing in the last 2 years, and we will experience in the short term, we will keep experiencing this. I mean, a strong demand all around through the year, despite without any peaks, it's just strong in general. And if you combine this with the port congestion that Evangelos touched upon before, it's if you saw even last Thursday in around the U.S. West Coast ports, you would see about more than 103 ships waiting. So if you factor in the congestion as well, we don't expect peak, spikes and declines. We just expect the market to move sideways or even higher on a short-term basis.
Filippos, a concluding question. Given the supply-demand fundamentals and the sector outlook, do we see the charter periods to become longer? The charters would like to have ships for longer than, I mean, in the past, I think it used to be 3-4 years. Maybe now it's longer. Do you see that demand?
The demand is there. I mean, we experienced in the past this long charter you mentioned. Then we went to a completely different market with short durations, very flexi back in the past, like prior to 19. And we're getting back now to a level which we saw before, a more sustainable level where, depending on the size, you get 3 to 5 year durations at healthy rates. And that's where we are today. And that's where we expect to be, at least in the foreseeable medium future.
Perfect. Well, let me thank you very much for being with us today. And I'll remind our audience that this presentation will be available online for those who would like to come and visit it, access it later on. Thank you very much.
Apologies again from my side for being late.
Thank you, Nicholas. Thank you for having us on. And we should all wish good luck to Filippos driving home amidst a snowstorm. So, yeah.
It's very interesting. We are in New York. Snow in New York is a kind of a usual annual phenomenon. When it doesn't snow, we say, where's the snow? In Athens,
It's different.
Snow is not a regular occurrence. So,
yeah.
Anyway.
Okay.
Thank you very much.
Thank you.
Thank you.